Let's take a look at our 60-minute chart of the S&P 500, the ES, to see what happened during the week and what little news there was out there that could have influenced the market. You could see what happened on Monday. Basically, the market was moving up overnight. Notice the gap right over here. There was some relief after North Korea did not launch anything. They expected that to happen over the weekend. Of course, it did happen then on Friday, so you got a pretty good uptick and a nice up day on Monday. Dollar had a bounce, and gold started to correct to the downside, and the S&P 500 moved to a record. And by the way, it moved to a record also on Tuesday. Gets a lift early in the day from Apple on their launch, and they have a $999 iPhone X, which to me is going to be a very, very tough sell. Bonds break on UK inflation up 2.9%, and that might be the beginning of some trouble for the bond market. Apple suppliers on Wednesday were pulling back as there's a delay on when that iPhone X is coming out, so they were leading the markets lower overnight, but then oil stocks got firm. The IEA said demand for 2017 was going to be stronger than originally anticipated, and that gave the oil stocks a lift. Oils are on the list of my best stocks for the week. You're going to want to see that. Then Thursday came, and another day where the market moved down early. You can see right here before the opening where the CPI comes out at plus 0.4%. The year over year now at 1.9%. The core up 0.2. The year over year at 1.7%. This is the minutia. This drives me absolutely out of my mind that the Fed is looking at these little tenths in here and sitting at 1.25% on interest rates. I mean, this is some sick stuff that they're looking at that. In the morning on Friday or late afternoon on Thursday, we got this news that North Korea had shot another missile over Japan, and the response is just absolutely ridiculous. It's nothing. I'd be shooting down their missiles. That's what I'd be doing. And so the market had a little blip to the downside, you could see, and then basically rallied throughout all the way into the afternoon on Friday. And here we are with about an hour and a half to go in the day. You can see we got this little flag being formed in here. And like I said, we went from small ranges to almost no ranges. Look what's going on in here as these are quoted in half points. You could see that. I mean, it's just very, very narrow range in here. In fact, these last 3 days in here, I've had a range in the futures from 24.98 down to about 24.88. So a 10-point range in 3 days. I mean, this is some sick, weak stuff when you look at that, and that is what happened in the on the 60-minute chart of the S&P 500 for the past week. All of this analysis that I bring you, this is hours and hours and hours of work. It takes a big team. I have analytical support in RV, and we have to run this whole business with our support team. And the only way we can continue to do that is if you become subscribers. Thank you to all of the people that are out there, the many subscribers that we have, because you allow us to keep bringing all of this information. And I'm asking you, the people that are watching this show, that is a free show, to become a subscriber. Help us to continue to bring all of this information all the way until my retirement, whenever that is. So become a subscriber and help support the business and help us to keep bringing this information. Let's take a look now at the stock market. SPX is where we're going to start, the S&P 500. So what we believed was going on was that the intermediate pattern had moved past its period of extreme risk. We talked about that a few weeks ago where we said the time was running out, and then we thought that it had ended. And that proved to be correct. So here is the chart on the S&P 500 SPX on the short term. Now, this is pretty significant. First of all, there are two cycles in there, and the dotted line is the one that's become dominant. It's about 16, 17 days is what we're looking at in there, and you could see all these 16, 16, 15, 16. That's the one that's really become dominant. That low is due actually right now. but all we're getting is a sideways move in there. That is extraordinarily bullish. You can see where this older cycle affected the market right in here, and it made a bull triangle, and then it broke out on Monday out of that bull triangle in a big way. So this was a very solidly bullish pattern, and now the upside targets in here are looking like they're right around up here. So this is the fib extension line at about 25.20. If we pop through 2500 and all we've been able to get up to is all 24.99 and a quarter, the way this pattern shapes up is that we're likely to get a lift in here. But you see this little note to myself in here where it says VIX low due right there? There's a VIX low due, and I'm going to show you that in about 3 or 4 days. I'm thinking this next rally in here is not going to last long. Maybe you spike up past 2500, maybe you get to that fib extension at 2520, but then I think it rejects, and rejects in a big way. So the pattern right now that we're seeing is positive, and there's no way to argue that. And we've been seeing positive patterns in here for the last several weeks as we move past this period of extreme risk. You could see that right over there, you could see it right over here, and we got some declines, but they were pitifully poor when you see that. We didn't even get a 3% decline. I mean, that is incredible when you see that. So a super strong market. And now when we get into this corrective period and all we do is get these little dots right in there, we've lost all volatility. That says that you're likely to get one more pop. We're going to call for an up week that fails as it crosses over 2500 and then pulls back. So we're going to call it 3-4 days on the upside and then down. Maybe it rallies into the Fed and then has a big reversal, which is a common thing for it to happen. So that's a look at the S&P 500. Now when you look at some of these other indexes, and I'm going to go back to momentum in a second and show you that. You can see in here that when we look at this one, the dip was a little more well-defined, as is the rally in here, as Apple gets a pullback and then a little bit more legs. Here's that VIX low due, so we get 3-4 days on the upside into the Fed and then turn down. That's what I think that the pattern is calling for when I look at that. You could see the Russell RUT in here, a similar pattern. Note the option bias extreme oversold right in here. It called the bottom perfectly, and then we get the rally and barely a downtick in here. So just incredible strength, and so we're going to look for a little bit period of more advance in there. Take a look at the Russell. You could see the Russell moves into a period of positive momentum, and no doubt that it's looking strong in there. It's not even overbought when you look at the projection oscillator. The NASDAQ and the X, you could see that still looking strong, and when you look at the SPX, you could see that and still looking strong. So all of those give you a sign of positive momentum. One more chart that I want to look at, though, is this chart right in here, and that is the intraday momentums, and you can see they're all super strong. But the one thing that I want you to note in here, and maybe it's just a little bit of a sign, or maybe I'm looking at straws, but you can see the NASDAQ is starting to show relative weakness to these uptrends in strength in all of the other indexes. You can see that the Dow Jones is the strongest one of all when you look at this. So this is Apple, and we talked yesterday in the cluster risk video about the fact that there are a few of these stocks in the NASDAQ that are starting to show negative signs. That's an important thing. We're going to watch for more of that, and likely that the NASDAQ will be the downside leader to me if there's any truth in the fact that the market is peaking. So I wanted to come back to this chart, the S&P 500. I want you to see the VIX low due and why I have this projected to 3 or 4 days on the upside. We're going to switch over to the VIX chart right here, and you can look right in here, and you can see these patterns in here that call basically for each time you get to the bottom of these what we call nested cycles right in there, you get rallies in the VIX. So you see it here and here and here and one here that did not last very long and declines right to this period. This is 3-4 days, we'll call it, and that's why I believe that the stock market might pop over 2,500 and maybe rally into the Fed, but then after that we're looking at the next period of stock market weakness right over there. Now all we know is the VIX is likely to rally. We also believe that that would coincide with the stock market ticking on the downside. We do not know the magnitude of the decline, and based on when we see that, it only helps us with timing. So that's why I believe that, like I said in the beginning of the show, you likely could count how long this rally has left in days. That's the way it looks to me, and I think it's going to get spent on the upside, and maybe it's right into the Fed. Man, I showed you a lot in this show. Don't forget, follow me on Twitter at askSlim. Go to YouTube and follow our videos over there. Become a YouTube subscriber and become an askSlim member and help us keep all of this information coming to you as we do. I hope you enjoyed that video. Be sure to subscribe to our YouTube channel and also go to askSlim.com and become a level 1 member. No cost to you, and we have some special videos for you to see. I know you'll enjoy them.